dig into the best ways to play the markets this earnings season. We want to bring in Ken Mahoney, CEO of Mahoney Asset Management. Ken, it's good to see you. So first, let's just talk about your overall takeaway with earnings, because the bar has been set low overall when we're expecting this drop in profit for the quarter. And we're seeing the names already not meet expectations. What is the signal about the moves we'll likely see in the coming months?
Yeah, it's funny. We sometimes come limping into earnings, the bar is low, and we get some pretty good reaction. On the other hand, we come in hot into earnings, which we are, expectations are higher, and there's that disappointment selling news that we saw with Netflix and Tesla last night. So I've seen these cycles before. We are coming in pretty hot into earnings, set the stage for selling news, unless somehow it can just totally blow out the expectations going forward.
And Ken, you're also pro-growth over value. Historically, we have seen growth outperform value as we head into a recession. So how much of a recession risk does that factor in your calculus when you're more growth over value?
Right. So a lot of it's kind of bottoms up, looking at company by company, looking at growth, and then you end up with this kind of big tech, so to speak. We've been hearing about this recession, and it probably will happen at some point. The inverted yield curve, the 10s, the 2s. I've been hearing about this for almost a year now. And, that bearish argument and why it may be sound, it may happen, the opportunity cost is pretty immense sitting on the sideline waiting for that. So we're still in the fast lane. We're still in that growth lane. We're still in that AI lane. We understand there's bumps and bruises there. But certainly we don't want to be overly bearish, because at the end of the day, you can make all the arguments you want. The final arbitrator is price. And since October, at some point, people point towards January, we've been making higher lows, breaking through resistance time and time again, and we have to look at price.
Ken, what does the upside potential look like for the market? You mentioned the fact that maybe some of the leaders that we'll see in the second half of the year weren't necessarily the leaders in the first half of the year. But when we take a look at the S&P right above 4,500, what is that upside? Is there much upside potential from here?
Look, I think you probably first have to go back and fill a little bit. You see today a rotation when people say, hey, stocks are down. Like, not so quick. JP Morgan hitting a year high. You have energy stocks. Exxon I saw up earlier today. So you're seeing some money coming out of tech, which makes sense, rotating into some areas that are kind of lagging, again, the very hot NASDAQ index. But I think going forward, probably when they say easy money, there's no such thing as easy money. But the NASDAQ, it's going to be pretty hard to duplicate what happened the first half of this year to the second half of this year. But I do think investors should have a balance. I think the risk reward is now kind of equal. I do believe last October, January, it did favor investing because you already sucked the air out of the market. You already had the risk that happened. So I think right now it's kind of equal weighted where we are in the marketplace right now.
And Ken, the Fed set to meet Tuesday and Wednesday. Another rate hike is likely to come. But is Jerome Powell's path to 2% inflation worth the risk to the economy? You say it's not. Why do you think that's the case?
Look, I think it's foolish, but that ship has sailed. That 2%, we're not going to see that for some time. And what is the damage from bringing inflation, let's say in the high 3s, low 4s, down to 2%? How many people have to be laid off to kind of play this little game of the Federal Reserve? And that's my concern, is that some people, they don't mind paying a little bit higher prices, but they have job security. But if the Federal Reserve really wants to break something and really want to break something, you keep keeping that 2% target, and we will start breaking it. We'll start breaking the labor market. And I don't think that's right to be playing games with people's lives.
Ken, what should be the target? What should the Fed be satisfied with?
At this point, I'm in the 3% camp. I think we all can live with it. That ship has sailed at 2%. Be nice to get there, but to use so much of a wrecking ball to get there, I think 3%, I think most people can live with, and still have a tight labor market or a strong labor market with 3%. I think we all can live with that.
And Ken, let's say the Fed does continue to raise rates and we do enter this period of economic destruction. What do you think will be the biggest thing to get hit? Is it that labor market?
I think the labor market, of course, REITs will get hit, equities will get hit, pretty much any risk on asset class will get hit with that. And it's also the uncertainty of the path, because most people thought, like we were telling clients, we're in the 8th or 9th inning of the rate hike cycle, right? Rate hikes. And here we are in extra innings. I know 10th inning, 11th inning, still kind of quarters and so forth. And quarters can add up if you keep doing this. So I think the Federal Reserve should just kind of stay cool a little bit. The direction from, look where we were last year this time, 9.1, 9.3% CPI. Now we're in the high 3, low 4s. We're going the right direction. So I really don't know what their haste is all about.